The Trump tariff market crash has caused me to lose more money than I ever had before, but I was surprisingly chill about it, and I needed to figure out why. So I took a look back at all the situations I had been in before, all the decisions I was making, and the portfolios I owned. It turns out, in hindsight, I was just not being very smart, but I eventually noticed a few things that made it clear to me why this time was different. And I want to share what I've learned with you because I wish someone had shared it with me a long time ago. And there's a few places in my portfolio where I'm still not following all this advice, but I'm really glad I spent time thinking about these things because now I can get to work fixing my portfolio and be even better off in the next market crash. It turns out the biggest mistakes I was making involved the things I didn't do. And I'll talk about that later, but first, let's get into the things I actually did. Because I've read a lot of books and articles, watched a lot of videos, listened to podcasts, a bunch of stuff to see how to do this well. And the problem is a lot of it just doesn't work. The things that did work are thinking of stocks like businesses, picking the ones that are high quality that you would plan to own forever, making sure they're in your circle of competence, and trying to buy them at a margin of safety. One of the big challenges here is that what quality is not always easy to know. And each one of these things is probably going to have to be its own video, so make sure you're subscribed if you want to hear more. And I don't regret learning all these other tactics that don't really work because now I know what not to do. And yes, they caused me to lose some money. There was a tuition fee, but I know them now, and hopefully I won't make those mistakes in the future. One of the things a down market teaches you is the difference between confidence and conviction, where confidence is the way you felt when you initially bought it, and conviction is how well it stands up to the tests of time. And this was the big thing I learned. The thing that all my mistakes had in common. Things that increase your confidence but don't increase your conviction are very dangerous. For example, one of the companies I lost money on was a company called Celanese, which I was very confident in at the time. But it turns out I was actually just combining two other mistakes. After looking back at it, I realized that the company had been outside of my circle of competence the whole time. And the only reason I was confident in it to begin with is because I was coattailing Warren Buffett, and I thought that one day the stock would sell for more than it was worth. I wasn't actually excited about owning the business. I was wrong to be so confident from the very beginning. And when my conviction was tested, I ended up having to sell the stock. I think it was the correct decision to sell it, but I really should never have bought it to begin with. There was a fear of missing out mistake because I was coattailing, and there was a margin of safety mistake because I thought that I could properly evaluate the business. But now I know to look out for these mistakes, which means hopefully in the next market crash, I'll own a lot more companies that I have conviction in, because everyone knows what they need to do during a market crash. You need to have a lot of money available so that you can buy low and sell high. But the fact is, very few people actually do that because it's hard to actually do. And people don't do it for different reasons. If I don't do it, it's usually been because I was distracted with one of these other tactics that don't really work. I would always get caught up trying to figure out what to do with these companies I probably shouldn't even own, that I didn't have a chance to look for new opportunities. And a big part of the reason I was more relaxed was because I did have the money available, but I also had a lot of other money that was locked up in stocks that I probably shouldn't own. And before the down market was here, I made the common mistake of looking at those stocks and thinking, no, I'll wait just a little bit longer for it to go a little bit higher. And then I missed my chance. And like I said, I still have a lot of these corpses of old decisions laying around, but at least now I know to do something about it for the future. I think this is the key reason why I was so calm, because my old portfolios were just so bad. What I needed was for more of the companies I owned to be these high quality businesses that I have conviction in. Now, I was definitely not as relaxed as I could have been, but I was definitely more relaxed than I had ever been, because the percentage of my portfolio I had conviction in was higher than it had ever been. After the crash was over, it was exactly these companies that I had conviction in that did well, and it was exactly the ones I didn't that did poorly. The only downside is that until I get a chance to change things, I have to live with the fact that my portfolio is not really where I want it to be. Being able to lean into the pain is a really valuable skill in investing, because it's better for you to feel bad knowing that you need to change things than it is to not know and just lose money the whole time because of it, which is what I was doing before I looked back at my decisions. And what I need to get better at is treating the times where there's not a down market as an opportunity to be harder on myself and to correct the things that I would want to correct once the down market was here. And you can try to do that by pretending that you're in a down market when you're really not, but there's nothing like the real thing. What I should start doing is just writing down my thoughts at the time I make a decision. That way I can look back and see if those things are still valid. But deciding which positions to go back and challenge is kind of counterintuitive, because the instinct is to say, let me check my oldest positions. But I think it's actually the other way around, where those old positions have already survived. Those are the ones you actually had conviction in. The first time I did this, I did it the other way around. and it ended up with me selling Costco, which was a disaster. I would have made a lot more money if I had just done nothing, which I would have been able to do if I could look back and say, yes, these things about Costco are still true. I shouldn't sell it. And maybe this is the key to staying calm, which is you make the times that aren't painful so painful that when the time comes that you do have a down market, you've already done the work. And yeah, it hurts. It's really uncomfortable. Trust me, I've done it a lot. But you need something that will let you translate the confidence you have to buy something into the conviction you need to hold it. But I would love for there to be an easier way. So if you know one, let everybody else know in the comments. Up to this point, my approach has just been to double down on the research. But that has issues too. It definitely helps, but it can also just dig you deeper into something you already like. And if you're not buying more of that already, then that means that the price of it has already gone past what you're willing to pay. So hopefully this new plan will work, where I record why I got into something and try to focus on those companies that I will be able to have high conviction in, which is tough because when you're doing research, you feel like you're actually doing something. But the goal is not to actually do something. The goal is to not lose money in a down market, which usually means owning stocks you don't have to sell. One of the benefits of this tactic, it lets me stop doing research that's redundant and focus on finding new opportunities, because down markets are not going to stop happening. And you need to be prepared because they really are some of the easiest times to make money. So the real best piece of advice for surviving down markets is to improve. Look back on what you did before and be better prepared for next time, because history is not doomed to repeat itself, but my bad results will if I don't do a better job. And the beauty of this approach is that I can't really lose. Either I come out ahead or I learn how to do things better the next time. Because every single down market I've ever been in, I've had more money than the one before it, which means I had more to lose, which means the price that I pay to learn what I'm doing wrong is actually going to be worth it.